Investing in the stock market can be daunting, especially for beginners. The thought of researching individual stocks, analyzing market trends, and making buy or sell decisions can feel overwhelming. What if there was a simpler way to participate in the stock market's growth potential without the complexity of picking individual stocks? What if you could pool your money with other investors and let experienced professionals manage it for you? That's the basic idea behind mutual funds. Mutual funds offer a convenient and potentially less risky way to invest in a diversified portfolio of stocks, bonds, or other assets. They provide an accessible entry point for investors of all levels, from beginners taking their first steps to seasoned investors seeking to diversify their portfolios. But what exactly are mutual funds, and how do they work? Let's delve deeper into the world of mutual funds and explore how they can be a valuable addition to your investment strategy. Imagine a basket filled with a variety of fruits. This basket represents a mutual fund, and each fruit represents a different stock, bond, or other asset. When you invest in a mutual fund, you are buying a share of this basket, giving you a small ownership in all the assets within it. A mutual fund pools money from many investors and invests it in a diversified portfolio of securities. This collective investment strategy offers several benefits, including instant diversification, professional management, and affordability. Instead of buying individual stocks or bonds, you purchase shares of the mutual fund, and the fund manager uses the pooled money to buy and sell securities based on the fund's investment objectives. Mutual funds are managed by professional fund managers who research, select, and monitor the assets in the fund's portfolio. These managers aim to achieve the fund's investment objectives, whether it's long-term growth, income generation, or capital preservation. Just as there are various fruits with unique flavors and textures, mutual funds come in different types, each with its own investment objectives and risk profiles. Understanding these can help you choose the right ones for your goals. Equity funds aim for growth, bond funds for stability, and money market funds for liquidity. Balanced funds mix stocks and bonds, while index funds track market indices. Choose based on your goals, time horizon, and risk tolerance. One of the key advantages of investing in mutual funds is instant diversification. Remember the basket of fruits? Instead of putting all your eggs in one basket by investing in a single stock or bond, mutual funds allow you to spread your investment across various assets. Diversification is essential because it helps mitigate risk. If one investment performs poorly, the other holdings in the portfolio can potentially offset the losses. By investing in a variety of assets, you reduce the impact of any single investment on your overall portfolio. Think of it like this. If you only invest in one company's stock, and that company experiences difficulties, your investment could suffer significantly. However, if you invest in a mutual fund that holds stocks from various companies across different sectors, the impact of one company's performance on your overall investment is minimized. Section 5. Understanding the costs of mutual fund investing. Investing in mutual funds is not free. While they offer convenience and diversification, it's important to understand the costs involved before investing. These costs can eat into your returns, so it's crucial to be aware of them. One of the primary costs associated with mutual funds is the expense ratio. This annual fee covers the fund's operating expenses, including management fees, administrative costs, and marketing expenses. The expense ratio is expressed as a percentage of the fund's assets. Expense ratios can vary depending on the type of fund and the complexity of its investment strategy. Actively managed funds, where the fund manager makes frequent trading decisions, typically have higher expense ratios than passively managed index funds. Another cost to consider is loads, which are sales charges or commissions charged when you buy or sell shares of a mutual fund. Front-end loads are paid when you purchase shares, while back-end loads are paid when you sell shares. No-load funds, as the name suggests, do not have sales charges. Understanding the costs associated with mutual funds can help you make informed investment decisions and choose funds that align with your budget and investment goals. Section 6. Navigating the risks of mutual fund investments. While mutual funds offer a potentially less risky way to invest in the stock market, it's important to remember that all investments come with risks. Understanding these risks can help you make more informed investment decisions and manage your expectations. Market risk, also known as systematic risk, is the risk that the overall market may decline, affecting the value of your investments. This type of risk is inherent in all investments and cannot be entirely eliminated through diversification. Interest rate risk is the risk that interest rate changes may affect the value of your bond investments. When interest rates rise, bond prices tend to fall and vice versa. Credit risk, also known as default risk, is the risk that a bond issuer may fail to make interest payments or repay the principal amount. leading to losses for investors. It's crucial to remember that past performance is not indicative of future results. The value of your investments can fluctuate, and you may get back less than you invested. Section 7. Mutual fund performance and the role of fund managers. When evaluating mutual funds, it's natural to consider their past performance as an indicator of potential future returns. However, it's important to remember that past performance is not a guarantee of future success. Fund managers play a crucial role in managing mutual funds and making investment decisions. They research potential investments, analyze market trends, and buy or sell securities based on the fund's investment objectives. The skill and experience of the fund manager can significantly impact the fund's performance. However, even the most skilled fund managers cannot consistently predict market movements or guarantee positive returns. When considering a mutual fund, it's essential to look beyond past performance and evaluate the fund's investment strategy, risk profile, expense ratio, and the experience and track record of the fund manager. Remember, investing in mutual funds is a long-term game, and patience and discipline are key to success. Mutual funds provide a convenient and potentially less risky way to invest in the stock market. They offer diversification, professional management, and affordability, making them an attractive investment option for beginners and experienced investors alike. However, it's crucial to understand the different types of mutual funds, the costs involved, and the associated risks before investing. Remember to consider your investment goals, time horizon, and risk tolerance when choosing mutual funds. Conduct thorough research, compare different funds, and don't hesitate to seek guidance from a financial advisor if needed. Investing in mutual funds can be a rewarding experience, but it's essential to invest wisely and stay informed. What questions do you have about mutual funds? Share your thoughts and comments below. Please subscribe, it is free. It will help us to create more financial education videos. God bless you.